Just as Bitcoin seemed to be finding its footing above $105,000, the entire market froze. A chill ran down Wall Street. Billions of dollars vanished from the crypto market in a matter of weeks. And it wasn't because of a hack, a black swan event, or some new regulation. It was because of something the Federal Reserve did and then suddenly stopped doing. They didn't explicitly attack Bitcoin. They didn't announce some secret crypto killing policy. They just got the market hooked on a story. And then, at the critical moment, they refused to deliver the final act. What we saw in November 2025 wasn't just a market correction. It was a carefully laid trap snapping shut. It was the moment the market realized the Fed was never going to be crypto's savior. They just pulled the rug, and billions of dollars in institutional money, which we were all told was here to stay, vanished almost overnight. In the next few minutes, I'm going to break down exactly what happened. We'll uncover the hidden mechanisms that drain the market, expose the illusion of the institutional hodlers, and reveal what this new reality means for the future of Bitcoin and your portfolio. This isn't the story you'll read in the headlines. This is what's really going on behind the curtain. To understand what just happened, we have to go back to early October 2025. The sentiment was getting choppy, but Bitcoin was holding its own. The narrative was simple. Institutional adoption was here. The spot ETFs launched back in 2024 were a roaring success, hoarding a significant chunk of Bitcoin's total supply. The post-halving supply shock was kicking in. Everything seemed aligned for the next leg of the bull run. But then, the momentum stalled. Between early October and mid-November, something shifted. Bitcoin fell from over $107,000, breaking below the psychological barrier of $100,000. Not once, but twice. By mid-November, it was struggling to hold the line at $93,000. A brutal drop that sent waves of panic through the market. The crypto fear and greed index, which had been cautiously optimistic, cratered to a state of extreme fear, hitting its lowest point since February. So what happened? The mainstream media will give you a list of scattered reasons: profit-taking, thin liquidity, fears of a looming recession. And while those are all contributing factors, they miss the elephant in the room. They miss the real antagonist of this story, the Federal Reserve. For months, the market had been operating on a single core assumption. The Fed was back in easing mode. After a long pause, the central bank had delivered small rate cuts in both September and October, trying to stabilize a shaky job market. The market priced this in as the beginning of a new easing cycle. Lower rates mean cheaper money, and cheaper money encourages investors to move into riskier assets like tech stocks and, of course, crypto. The entire 2020 and 2021 bull market was built on this very foundation. Investors, especially the big institutions, were betting on a repeat performance. They expected the Fed to keep cutting rates into December, creating a perfect tailwind for Bitcoin. Just a month ago, the odds of a December rate cut were as high as 93.7%. The trade seemed obvious, but in the weeks leading up to their December meeting, the Fed changed the narrative. There was no single shocking announcement. Instead, a growing chorus of Fed officials began publicly expressing caution, highlighting sticky inflation and suggesting a pause was needed. This hawkish chatter sent a chilling, unspoken message to the market. We are not your safety net. While everyone was waiting for the next cut, the Fed was signaling it was ready to stop the party. That cautious stance was a dagger to the heart of the market's expectations. The probability of a December rate cut collapsed from over 90% to just around 44%. The dream of a new easing cycle was over, at least for now. This is the rug pull. It wasn't a loud, aggressive action. It was the silent withdrawal of expected support. Bitcoin and other risk assets are like plants that have been grown in a greenhouse with perfect conditions. Endless water and light provided by low interest rates. Institutions rushed in, believing the perfect weather would last forever. But in November, the Fed simply signaled it was turning off the sprinklers and dimming the lights. It didn't have to actively poison the plants. It just had to restore normal, less accommodating conditions. And the institutional money, which is notoriously risk-averse, was the first to run for the exit. The market, which had become addicted to the Fed's support, suddenly found itself in withdrawal. And the crash we saw was the direct result of that painful realization. It was a confluence of macroeconomic reality colliding with crypto-native speculation. For the better part of a year, the story that fueled this market was the institutions are here. And the prime evidence was the massive inflows into the new spot Bitcoin ETFs, particularly from giants like BlackRock. It seemed like every day we saw headlines about billions of dollars pouring into these products. It looked like Wall Street was finally embracing Bitcoin as a long-term store of value, a digital gold for the 21st century. But what if I told you a huge portion of that money wasn't from true believers? What if it wasn't long-term conviction money at all, but rather sophisticated hedge funds executing a simple arbitrage trade? This is the dirty secret of a 2025 institutional rally, and it's called the basis trade. Understanding this is critical to understanding why the market fell apart so quickly. Let me break it down. An arbitrage trade is just taking advantage of a price difference for the same asset in two different markets. But basis trade, in this case, involves two things: the spot Bitcoin ETF and Bitcoin futures contracts on an exchange like the CME. Here's how it works. A hedge fund would buy shares of the spot Bitcoin ETF, and at the exact same time, they would short or bet against Bitcoin futures contracts on the CME when the futures price was significantly higher than the spot price. This was a highly profitable, low-risk trade. The hedge fund wasn't betting on Bitcoin going up. They were simply capturing the spread between the two prices. So, when you saw headlines screaming about millions flowing into Bitcoin ETFs, a substantial chunk of that was not a pension fund deciding to hold Bitcoin for the next decade. It was a hedge fund buying the ETF as one leg of this arbitrage trade. It created the illusion of a massive one-way wave of institutional conviction. But here's the problem with a market built on arbitrage. The trade only works as long as that futures premium exists. As market conditions tightened and the Fed's dovish tone disappeared, that premium began to compress. The easy, risk-free profit from the basis trade started to disappear. And what do hedge funds do when a trade is no longer profitable? They unwind it. Unwinding the basis trade means doing the exact opposite of what they did to get in. They sell their spot ETF shares and simultaneously buy back their short futures contracts to close the position. So all of that buying pressure from the ETF inflows suddenly reverses and becomes massive selling pressure. This is the hidden source of the institutional rug pull. It wasn't a change of heart about Bitcoin's long-term value. It was a simple mechanical unwinding of a crowded trade. Look at the numbers. In a single week in November, spot Bitcoin ETFs saw over $1.1 billion in net negative outflows. On November 13th alone, there was a staggering $870 million outflow, the second worst single day on record. This wasn't panic selling in the traditional sense. It was the sound of thousands of arbitrage bots automatically closing their positions as the profit vanished. The institutional buy wall that had supported the price for months suddenly transformed into an institutional sell tsunami. This selling pressure cascaded through the market, triggering over $1 billion in liquidations and pushing the price below key technical levels like $100,000. Once that psychological level broke, real panic from retail and short-term investors set in, amplifying the crash. So the institutions that everyone thought were building a foundation for Bitcoin were, in many cases, just renting it. And when the conditions changed, they packed up and left without a second thought, leaving the true believers holding the bag. It proves a hard lesson. ETF flows are not a pure measure of institutional belief. They are often just a barometer of the futures curve and the latest arbitrage opportunity. Now this is a crucial point that a lot of people are missing, and it changes how you need to think about this market. The money that just left was never really here for the long term. If you're finding this breakdown helpful and want to stay ahead of the narratives that drive these markets, do me a favor and hit that subscribe button. It's free, and it ensures you get these deep dives as soon as they're released. Don't just follow the price. Understand the forces moving it. Alright, let's get back to the other cracks that were forming beneath the surface. While the Fed's pivot and the unwinding of the basis trade were the main triggers for this sell-off, they were pouring gasoline on a fire that was already smoldering. The crypto market had its own set of internal problems, structural weaknesses that made it incredibly vulnerable to a macro shock. These are the cracks in the foundation that turned a sharp correction into a potential bear market. First, let's talk about the ghost that still haunts this industry, FTX. It's been 3 years since the collapse, and you might think the market has moved on, but the trust deficit it created is a deep, unhealed wound. For institutions, trust and legal certainty are everything. The fact that, as of November 2025, FTX creditors are still navigating a complex, multi-year repayment process is a constant reminder of the counterparty risk in crypto. Though a plan was approved in late 2024 and payments are being distributed in stages, many creditors are furious that they're being repaid based on the rock-bottom crypto prices from November 2022, not today's values. Does watching that unfold make a pension fund manager want to rush in and allocate $1 billion? Absolutely not. This lingering mess keeps a huge amount of conservative capital on the sidelines. The second crack was a major stress test on the corporate accumulation model. Throughout 2025, companies like the former MicroStrategy, now just Strategy, were celebrated as heroes of the bull market. Their strategy was a powerful flywheel: issue stock or take on debt to buy more Bitcoin. But this model is fragile. It relies on ever-increasing prices and investor optimism. When the market started to turn, the company's stock price took a beating, falling over 50% in just a few months. The original script got this next part wrong, though. It didn't collapse. In a stunning show of conviction, Michael Saylor just announced one of his biggest purchases of the year, buying over 8,100 Bitcoin for $835 million while the market was bleeding. He funded it by selling preferred shares instead of common stock, a move to avoid diluting shareholders at depressed prices. So while the flywheel is under heavy strain, Saylor is doubling down, creating a fascinating battleground right in the middle of this market chaos. The third crack is perhaps the most fundamental: finning market liquidity. Think of liquidity as the amount of water in a pool. If the pool is deep, a big person can jump in and it barely makes a splash. If the pool is shallow, the same person creates a massive wave. In the crypto market, the pool has been getting shallower. Following the FTX collapse and other crises, many of the largest market makers, the firms that provide liquidity to exchanges, have pulled back. This means a relatively small number of large self-orders can move the price dramatically. This is exactly what we saw. The wave of selling from the unwinding basis trades hit a very shallow market. There weren't enough buyers waiting in the wings to absorb the pressure. So the price plummeted. A sell-off that might have caused a 5% dip in a more liquid market caused a crash. This creates a vicious cycle. Volatility spikes, which scares off more investors and causes liquidity to dry up even further, which in turn leads to even more volatility. Analysts have been flagging this for weeks, noting that weak retail sentiment and cautious institutional buyers have created a fragile market structure. So when you put it all together, you see a perfect storm. The Fed provided the macro trigger, signaling the end of the easy money party. This caused the basis trade, a pillar of institutional demand, to unwind violently. And all of this happened in a market that was already suffering from a trust deficit from FTX, a strained corporate buying model, and dangerously thin liquidity. It wasn't one thing that pulled the rug on Bitcoin. It was a series of interconnected failures that brought the whole structure down. So, the big question is, what now? Is this the start of another crypto winter, or is it just a brutal but necessary reset? The honest answer is that the game has changed. Bitcoin now behaves far more like a traditional macro asset. Its fate is inextricably linked to the decisions of Jerome Powell, to the strength of the US dollar, and to global liquidity conditions. We can no longer just look at on-chain data and assume the price will go up because supply is scarce. We are now tied to the gravity of the global financial system. In the short term, the outlook is precarious. The price of Bitcoin is trying to find a floor around the $93,000 to $95,000 level. This is a critical zone. A failure to hold this support could open the door for a deeper correction towards the $88,000 to $90,000 range, or even lower. The market is top-heavy and needs time to digest these losses. We are in a phase of consolidation. The market is fragile, and any rallies are likely to be met with selling. The key event everyone is watching is the Fed's December meeting. Any hint of a dovish pivot, a signal that they are indeed worried about the economy and are ready to resume cutting rates, could provide a floor for the market. Conversely, if they double down on their hawkish pause, we could see another leg down. Investors are on edge, waiting for clarity that has been clouded by a recent US government shutdown and delayed economic data. But let's zoom out and look at the bigger picture. Is this all doom and gloom? Not necessarily. What this event has done is wash out the tourist institutions. The hedge funds that were here for a quick, risk-free profit on the basis trade are now largely gone. The buyers who remain are likely those with a much longer-term conviction. This is a painful but healthy process. Furthermore, the very actions of the Fed reinforce the core value proposition of Bitcoin for many. The central bank's ability to devastate the market with subtle shifts in tone underscores the need for a decentralized store of value that exists outside of its control. Every time the Fed pulls a lever that causes chaos, it serves as a multi-billion-dollar advertisement for Bitcoin's core purpose. The other positive sign is that despite the price crash, there are still signs of genuine institutional and regulatory engagement. Federal Reserve Governor Michael Barr recently gave a detailed speech on a new stablecoin law, a sign that the highest levels of finance are taking the ecosystem seriously and working toward a clear framework, even if they're cautious. The path forward for investors requires a shift in mindset. First, you must accept that macro is king. You cannot be a Bitcoin investor today without also paying close attention to every word that comes out of the Fed's mouth. Second, you have to be far more skeptical of ETF flow data. Inflows are not always a sign of bullish conviction. You have to look deeper at the futures market and the basis to understand what's really driving the flow. Third, this is a time for patience. Markets that experience this kind of violent deleveraging need time to heal. It's unlikely that we will see a V-shaped recovery back above $100,000 anytime soon. So did the Fed just pull the rug on Bitcoin? Yes, but not in the way most people think. They didn't orchestrate a malicious targeted attack. They simply stopped playing the game the market expected them to play. They withdrew the promise of endlessly cheap money, and in doing so, they exposed the fragile foundations upon which the recent stability was built. They revealed that much of the institutional adoption was just sophisticated arbitrage. They showed how vulnerable the market is to a liquidity crunch. And they reminded everyone that as long as Bitcoin is priced in dollars, it will be subject to the monetary policy of the US Federal Reserve. This has been a painful lesson for many. Billions of dollars in paper wealth have been erased. But for the long-term health of the market, this was a necessary purge. It has shaken out the weak hands and the hot money tourists and forced a much-needed reality check. The road ahead will be choppy. The market is now fighting through a period of extreme fear, thin liquidity, and macro uncertainty. But it is in these moments of crisis that the true believers are forged. The narrative has been reset. The speculators have been flushed. Now the real building can begin. What do you think? Is this the beginning of a prolonged bear market? Or is it the healthy correction Bitcoin needed before the next major leg up? Let me know your thoughts in the comments below. And as always, thank you for watching.